In the last 2 decades, mutual fund investing has become a very common tool for common people like us to invest, to pursue and accumulate wealth in our life. These funds, they not only offer the potential to beat the inflation, but it also provides a way to manage risk. But she, who looks beautiful up front, can often be very scary. And many who flock around without a precaution can often get bitten. Which makes it evident to keep yourself safe. Are you? As greats say, knowing what not to do is more important than knowing what to do. This video focuses on the don'ts of the mutual fund industry, of mutual fund investing. Stick around, this video will overcome the odds. It will overcome the frenzy. We will dissect the don't do's in your investing journey. It's important. It's simple, but most of us don't follow these. And that's the reason why I always say investing is tricky. It's not easy. Every step you take in the financial world is a challenge. And with this challenge comes the next big opportunity. This video will give you an insight, but the next one I post can bring you that next big opportunity. So like this video and subscribe to this channel right away, because you don't want to miss it, do you? The biggest mistake in mutual fund investing that people does is they try to gain quick wealth by investing in mutual funds. Mutual funds is not for short term. When people don't have a clear goal and they want to earn quick money, they think mutual fund can be the vehicle. No, that's not. Avoid investing in mutual funds for short term. It's essential for you to have a longer period of time frame. Maybe 5 years, 7 years, 10 years, or even more. It's only and only then you can start thinking of investing in mutual funds. Market follows cycles of outperformance and underperformance. Short-term investments might not give you the desired results, unless of course you are extremely lucky. And on top of that, investing without a clear specific goal can lead you to an undisciplined investing and eradicate decision making at the time of volatile markets. If you have a clear goal in mind, that will help you endure and stick around even when the choppy waters are at your feet, and hence help in accumulating huge amount of wealth over a longer period of time. Number 2, realistic targets and realistic investments. Some people just invest. They just have some money, they put in some money, and they think they have started their investing journey. They just feel, okay, I got 1,000, 2,000 rupees, I'll start a SIP, that's it. No specific goals in mind, no specific plan, no direction. They get a few $1,000, they invest in lump sum. They think investing is a child's play game. Go as you like, dress as you like, is it? No. Now this happens when you do not have a goal in your mind, when you do not have a target to achieve, when you do not have a specific number to hit by a specific period of time, or within a specific time frame. People think of becoming a crorepati. They think of aiming or amassing 1 crore, but they start, or maybe they do a SIP of 2,000, 2,500 rupees a month. How many years will it take to be a 1 crore? With that amount, some calculations, they just don't fit the mathematics formula. They even do not qualify to be on the systematic investment plan SIP calculator table. Even if they do, they'll just fly off beyond your expected imagination. If you do a SIP of 2,000 rupees and you aim to accumulate 1 crore, you might get it someday, but probably that day will come 10-15 years after you die. 2K a month and you wish to achieve 1 crore, it'll approximately take you would need at least 30-35% CAGR returns for the next 15 years. That's just insane. It's insane in the mutual fund industry. It's beyond practical implementations. It's beyond practical thoughts. But people believe they can do that and they jump in. So you need to be realistic. Either you need to have a realistic return number in your mind and calculate your final corpus based on that, or have a realistic end corpus in your mind and start investing based on that final number. If you really want to achieve 1 crore, 2 crores, have a realistic SIP amount with a realistic CAGR number that can actually help you achieve that number by the time you retire. Or maybe 20,000 per month, possibly at 12-13% CAGR for 15 years can get you to 1 crore. That is a realistic number, not 2,000 rupees a month. Number 3, stopping a SIP or making a partial withdrawal. If I ask you what are the chances of you buying a car or buying a house in the next 5-10 years, you would probably say 0. You have probably started a SIP to accumulate 1 or 2 crores for your retirement. That's your aim. You need to have 2 crores for your retirement. And you wish to invest then 15,000 rupees a month. You're in your 20s. And you start a SIP of 10,000 rupees. Possibly by the time you retire, you can still achieve that number based on the funds that you have invested in. You can get to that number probably. But what happens is 15 years down the line, or maybe 10-15 years down the line, you see a handsome amount of money has accumulated in your corpus. You suddenly feel the need to buy a car. You suddenly feel the need to buy a house. I'm not saying those are not important. Those are important assets. A house is an important asset. I mean, even if it's not an asset, a house is an important purchase. It lets you live. A car is an important purchase. It lets you commute safely, comfortably. But you know what? You set out with an aim to accumulate 2 crores by the time you retire. Halfway down the line, you withdraw it to buy a house. You take out your money to buy a car. Absolutely horrible. Stopping a SIP disrupts the continuity of the investing journey. It disrupts the discipline. It hampers the accumulated units. SIPs help in averaging the investment cost, and this is where it gets hampered. Number 4, reacting to the market. Well, this is a very, very common phenomenon with a lot of investors. When there is a panic in the market, many of us tend to sell off and book their profits. Market downturns presents with you the opportunity to accumulate units at a lower price. But many investors just do the opposite. They sell off to book profits, and they sell off often at a loss of capital. To achieve a long-term capital growth, long-term wealth, it is very important to have control over your emotions. It's very important to focus on your predetermined horizon. Market crashes are short-lived, and they often offers you with the opportunity to buy assets at a very dirt cheap rate. If you redeem your units at the market downturn, it resets your investing journey altogether again. And achieving what you have set out to achieve then starts to look very, very challenging. Chasing the top performing funds. Many investors, they tend to chase the outperforming funds. They tend to chase the funds that has given good returns in the short while, in the near future, in the near past, overlooking the guarantee or the warning that the mutual fund industry gives us. Past performance does not guarantee future performance. Shifting your existing schemes into the top performing schemes are not always the best decisions that one makes. We should allow some time, at least 2-3 years, for any mutual fund to show its performance. It might be possible that it might take a couple of years to get into the realm of the market, to understand what they are doing. Reassessing schemes too frequently does not help. It actually helps in missing the better opportunities. Funds that has performed well in the past might not do so well in the future. And you, at this very moment, see the last 4-5 years performance for this fund, you think this is going good, you switch your investments here, the fund started performing worse. It might slip into underperformance. What will you do? Sectoral or thematic funds. Well, at times, certain sectors do well in the market, but it's very difficult to understand which ones those would be. What sectors would perform at what duration and for how long? That's a very, very difficult task. Many investors, they are attracted to these sectoral funds. Why? Because they offer huge returns over a very short period of time. Not many investors can get these numbers correct. And what's more dangerous is the top performing sectors, they keep changing from time to time. So possibly if you have identified a correct sector, a correct theme for this year, it's quite possible that that particular theme may not perform well the next year. What would you do? You would redeem again, look for another theme, another sector. Can you guarantee that sector, that theme would perform well? You would sell off from here, pay the exit load, buy another theme, pay the short-term capital gain tax, and the new theme you purchase, it's not a guarantee that it will perform. What if it doesn't? Number 7, heavily invested in small and mid-cap funds. These are risky funds. You cannot invest a major portion of your wealth into these funds. Yes, these are necessary. Investing in small and mid-cap funds are necessary for a good balance of your portfolio. But it's not necessary to invest the major chunk of your portfolio into small and mid-cap funds. Because when they fall hard. They wipe out a mass majority of your portfolio. So it's only and only if you are willing to take a high risk, you can only go with these funds, or else put in a small portion into small and mid cap, maybe 20-25% in small cap, another 20% in mid caps or flexi caps, and that's it. The remaining should possibly be into much safer investments in the market. Maybe the index funds, the Sensex or the Nifty. Not reviewing your portfolio time to time. That's a big mistake. You should review your portfolio at least once a year. I understand I have told you not to switch over or rebalance or sell off a fund before 2-3 years. Then why review and rebalance? It is required because reviewing your funds lets you understand how they are performing. If they're not performing well, maybe you can give it a amber flag. You can put it in watch list. That's an indication that you need to be very cautious. You need to study the themes. You need to study what has happened to this fund. Why is it not performing the way it was? What went wrong? Did the fund manager change? Did the underlying assets change? Did the investing objective change? Did the AMC change? Did the fund theme change? Did the AMC change the fund type? Maybe it was a small cap fund, it's now a mid cap and a small cap fund. Maybe it was a large cap fund and now it has moved on from being a large cap fund to index fund. What has happened? You need to know what has happened. That's the reason why you should be reviewing your funds on a regular basis. There are many funds which I have personally held on to for the last 15-16 years. They have changed their names, they have changed their investing objective. Small cap funds have changed their names from small cap to small and mid cap. From small and mid caps, they have changed it to flexi cap. Yeah, you can keep them as it is, continue with them as it is if it meets your objective. For the last 15 years, my objectives have changed. So does yours. If that happens, and if those funds change as per your objective, you can continue to stay invested in them. If not, you should change. You should move on. Not setting up a SIP. People think I will invest in mutual funds every month on a regular basis. There has been videos, I've seen videos where people try to teach us Keep the funds with you. Watch the market. When the market falls, invest those funds. It's a good strategy to speak about, to chalk out on a piece of paper, to chalk out on an Excel sheet. It's good to talk about. It's good to lecture on it. But in reality, it doesn't happen. It can happen if you can actually work as per the plan, but majority of the time, your saved money doesn't remain in that account for long. If you keep waiting for the opportunity, some other emergency would come and you would withdraw it. It will not be in place to invest. And that is what makes it very, very risky for any investor. Setting up a SIP negates all these possibilities. It's just like an EMI. Your salary comes in the next week. The very next week, take your money out of your account. Put it into investments. It's as if you have already paid your loan EMIs. Take it as it is, you have paid your loan EMIs. If that is so, that's how you will be able to accumulate wealth. Else, no other formula works. You might say, I am quite diligent, I'm quite obedient, I have the discipline to invest, I can try that formula, it works for me. Good. You might be the one amongst the 1,000 people, or maybe one or two amongst those 1,000 people who can actually work that formula out. That particular formula which works good in Excel sheet, probably you're one of those people which can work that out, but it's not for everybody. And finally, the other common mistakes. After you have overcome all these 9 mistakes, the most common thing would be you invest, but you're not careful about it. By choosing a regular plan, by choosing a similar performing fund with a higher expense ratio, by investing or choosing the ICDW option. What is it? IDCW option. Investing in NFO funds. We do not know the track record. We do not know the performance history. How can I put my money into something that has not proven its worth? The biggest mistake is you see the NAV price as 10. You feel 5,000 rupees would fetch me 500 units for the first month, 500 units for the second month, and I'll fetch tons and tons of units. What if the fund doesn't perform? Fetching units will not help you. Your fund has to perform well. Where is the track record? Where is the history? Well, if you have decided to do well in your investing journey, this is the playlist which you should be visiting right now. Go ahead, click on it right now. As of this video, adios.